Let's quickly talk about transitioning from C Corporation to S Corporation. What are the tax implications? I first want to talk to you about the issues here. So the thing is that operating as an S Corporation may help reduce federal employment taxes for small businesses under the right circumstances, that's for sure. Although S Corporations may provide tax benefits over C Corporations, there are some potentially costly tax issues that you should evaluate pretty well before making a decision to switch. So here is a quick rundown of the most important issues to consider when converting from a C Corp to an S Corp. The first one is the big tax. So big means built-in gains tax. So although S corporations generally are not subject to tax, those formerly C corporations are taxed on built-in tax, such as appreciated property, that the C corporation has when the S election becomes effective, if those gains are recognized within 5 years after the corporation becomes an S corporation. So 5 years, that's the timeline here. So this is generally unfavorable though. Although, and there are situations where the S election still can produce a better tax result despite the big tax, the built-in gains tax. Okay, so the first converting issue that we have here is the big tax. The second one is passive income. So S corporations that were formerly C corporations are subject to a special tax if their passive investment income, such as dividends, interest, rents, royalties, and stock sales gains, exceeds 25% of their gross receipts, and the S corporation has accumulated earnings and profits carried over from its C corporation years. So if that tax is owed for 3 consecutive years, the corporation's election to be an S corporation terminates right away. So you can actually avoid the tax by distributing the accumulated earnings and profits, which will be taxable to shareholders. Or you might want to avoid the tax by limiting the amount of passive income in the first place. You also have LIFO inventories. So C corporations that use LIFO inventories have to pay tax on the benefits that derived by using LIFO if they convert to S corporations. By the way, LIFO, last in, first out. So the tax can be spread over 4 years, and this cost must be weighed against the potential tax gains from converting to S status. By the way, boss, welcome back to the show. It's really a pleasure to have you here. Make yourself comfortable. You are going to enjoy today's conversation. Another potential issue that you need to be aware of is unused losses. So if your C corporation has unused net operating losses, null, the losses cannot be used to offset the income as an S corporation and cannot be passed through to shareholders. So if those losses cannot be carried back to an earlier C corporation year, it will be actually necessary to weigh the cost of giving up those losses against the tax savings expected to be generated by the switch to S status. You also have other issues that you need to be aware of. So the thing here is that there are other factors to consider in switching from a C corporation to an S corporation status. Now, shareholder employees of S corporations cannot get the full range of tax-free fringe benefits that are available with a C corporation. See, what we call ancillary fiscal benefits. Okay, so those are not readily accessible for S corporation shareholder employees. And there may be complications for shareholders with outstanding loans from their qualified plans. So all of these factors must be considered to understand the full effect of converting from C to S status. See, the whole thing is that when you analyze the transition from C to S, and a lot of business owners look at only the fiscal elements of it. They look at the operational, of course, the operational angle, but they also look at the fiscal element. But you got to look at other things. The legal angle is really important. The regulatory angle is really important. Of course, the fiscal angle is really important as well. So you have a multidisciplinary sort of analysis that you need to really you need to conduct if you want to transition from a C corporation to an S corporation. Now, so I just want to quickly recap the 5 issues, the 5 converting issues that you need to be aware of. So the big tax, the built-in gains tax, passive income, LIFO inventories. So LIFO standing for last in, first out. This is an inventory valuation method. You have unused losses, and then you have other issues that could actually arise depending upon the specific C corporation that you're considering converting to S Corp. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about transitioning from C Corporation to S Corporation. What are the potential tax implications you need to be aware of? Let me give you a few pro tips here. So it's really important to understand that if you are going to do such a transition, it really might help to get help. Okay. And I'm talking about professional help here. So, and this help can come from three sources. It can come from an enrolled agent, it can come from a tax attorney, or it can come from a certified public accountant. So a CPA. So because when we talk about C Corporation, we're talking about a legal structure that has a pretty robust that has a pretty robust operation when it comes to the administrative part of things. Okay. And it's one of those things where you want to have somebody to kind of help you out. It's important to understand that there are some main factors to consider when you're thinking about transitioning from C Corporation to S Corporation. The first thing is that a C Corporation's earnings are double taxed, right? So double taxation, not a problem. So C Corporation has to file a Form 1120 and has to pay taxes on that form. And then when that C Corporation distributes its dividends to shareholders, those shareholders have to pay taxes at the Schedule C, Form 1040 level. So double taxation, we all know that, not a problem. Now, S Corporation doesn't have that. That's a cool thing. S Corporation doesn't have that, so this is really good. So S Corporation are generally exempt from taxes, but shareholders are not. So an S Corporation, once you actually achieve once you complete the transition, the S Corporation will have to file an informational return. In other words, we have a Form 1120S, and so this is an informational return. So the shareholders are not paying anything, or the shareholders or the company itself is not paying taxes while filing that form. But the company has to issue, along with Schedule 1120S, has to issue also from Schedules K1. So all the shareholders from the S Corporation have to receive Schedule K1, and then they have to actually transfer data from that Schedule K1 to their Schedule C when they file their Form 1040. Another thing you need to really understand here, and I think I just spoke about that, you have the big tax. So a big tax may be owed after C Corp to S Corp conversion. So a built-in gains tax. So this is why I was just telling you, don't actually hesitate to get professional help to kind of help you out to figure things out. Because the last thing you want is to actually do the conversion and actually have a huge tax bill waiting on your porch. You do not want to have that. So please enlist the help of a CPA, an EA, or a tax attorney to kind of help you out. Another thing you need to be aware of is that when you do the conversion from a C Corporation to S Corporation, conversions have a 5-year recognition period. So if a business owner, such as you or anybody else, converts from a C Corporation to an S Corporation, and the company waits 5 years to sell appreciated assets, big tax can be avoided. Instead, gains passed through to shareholders are taxed at the individual shareholder level. And what happens here is that when an S Corporation is terminated and becomes a C Corporation, the company will not have the option to elect S Corporation status again for a 5-year period. So this is kind of important to keep in mind. And so an S Corporation inherited passive income can be subject to tax, because a lot of folks say, well, it can be. I think I sort of alluded to it earlier when I said that after conversion from a C Corporation, an S Corporation can inherit income such as rent, interest, retained earnings, funds derived from stock sales, etc. And what happens here is that those have tax implications, not only in terms of filing Form 1120S, but also filing when it comes to filing Form 1040 Schedule C. Okay, and also there could be situations where you might have to also think about Schedule D, Form 1040, but also Form 8849. So this is investments 8849 and Form 1040. Okay, so those are things you need to be aware of. And also one thing I need to say also here is that an S Corp's inherited operating losses cannot be passed through to shareholders. So unlike null, as I said earlier, and I want to reiterate this because this really sort of trips up a lot of shareholders, S Corporation shareholders. I want to reiterate the fact that unlike normal operating losses, which can be passed through to S corporation owners for deduction. Inherited losses from the previous C Corp cannot be carried forward and passed through. So if there are net operating loss carry forwards, they cannot be used by the S corporation. So this is kind of important and to actually keep in mind. The process of LIFO recapture, which is described in section 1363D, prevents S corporations from avoiding the big tax by using the LIFO method of inventory valuation. Okay. I mean, they could use others. They could use FIFO. They could use LCM. LCM, that's the lower of cost or market. So this is something they could use. So at conversion, what happens here is that the difference between inventory valuation under LIFO valuation and LCM valuation is generally included in the C Corp's final tax return. And the tax attributed to LIFO recapture is payable in 4 installments. And it's one of those things where you have to see what really works for you. So not all C Corps can become S Corps. There are restrictions on S corporation stock. And also a business owner selling to an ESOP should consider the differences between C Corp and S Corp. So the bottom line here is what? Bottom line here is that you want to really weigh the pros and cons before conversions. Okay. You have to see what really works for you, what really works for your specific situation. And it's one of those things where, going back to what I said earlier about enlisting the help of a professional, this could be really helpful. And again, I'm not even talking about the state tax implications, because everything I'm telling you, we're speaking about the federal level of things. But you have to also consider the states where your C corporation is involved in. And basically, if your C corporation is involved in, conduct business in several states, then we have a situation where we have a completely multi-state sort of a tax situation. So every state will have its own rules. It's one of those things where you want to really enlist not just the CPA, not just your local CPA, but you want to enlist the help of a national tax firm, a national accounting firm who really understands the intricacies of taxes, of state taxes across multiple states. Okay, and that's really important. Also, it depends on the magnitude of assets and liabilities being transferred, right? Assets and liabilities being transferred from C corporation to S corporation, and so the larger those assets, the more qualified you want the tax firm to be. Let me give you a bonus here. Let's have a conversation about the benefits, the fiscal benefits of transitioning from C Corp to S Corp, or even a partnership for that matter. Are there tax benefits? Well, the thing here is that I've already established the fact that when we talk about C corporations, we're talking about right away double taxation. When we talk about partnership and S corporation, we have pass-through taxation. So we have simple like one type of taxation. So simple taxation or pass-through. In other words, S corporations and partnerships don't have double taxation. That's just the opposite. Okay. Now, there are some possible tax benefits of converting from a C Corp to an S Corp or a partnership. Let's talk about that. So what is the most obvious change here? After the conversion, the company's owners can avoid double taxation of earnings. That's the main advantage. So depending upon the corporation's earnings and its shareholders' tax brackets, this can result in significant savings. Can you imagine if a shareholder is in the 39% tax bracket, and from 39% they go from like 39% to 21% or 25%? That's huge. Okay. S corporation may also realize tax savings by distributing earnings to shareholders as dividends, which are not subject to payroll taxes. However, under current tax laws, each shareholder employee must be paid a salary subject to payroll taxes, and the salary may not be unreasonably low in the eyes of the tax authorities. The IRS uses a term called reasonable compensation. That's the term that the IRS uses. So if the IRS deemed the compensation too low, the agency may characterize dividend income as salary and actually assess payroll taxes to the company. Partnerships do not pay payroll taxes, although their partners are considered self-employed and therefore must pay self-employment taxes on income. Okay, now, are there any potential drawbacks after converting from a C corporation to an S corporation or partnership? Well, the thing is that when converting to an S corporation, the company may be subject to the big tax that I spoke about earlier. Okay, and this is what it is. And also, the fact that you cannot really pass through the C Corp's null to shareholders. So those are really important things. Also, LIFO as well. So bottom line here is what? Every situation is different. Every C corporation is different. Every S corporation is different. Every state is different. Every industry is different. So that's why you can either ask us in the comment section down below. Just ask your question and we'll get back to you. Or you can just enlist the help of a professional to kind of help you out. Let me give you the approach you need to really follow if you have to transition from C corporation to S corporation. So this is the approach. First of all, those are the steps. Here are the steps you need to take. Currently, filing Form 2553 is the only requirements to convert from a C corporation to an S corporation. So you want to file the form with the IRS to change the tax election, not a problem. Now the thing is that all shareholders must sign the form, and the time frame for submitting the form can be no later than 2 months and 15 days from the beginning of the tax year. So this will be the tax year when the S corporation election is made. So Form 2553, which is the election by a small business corporation, is then filed with the IRS. Okay, so Form 2553, that's a critical form to really have if you're thinking about converting from a C corporation to an S corporation. Then you also have another form. So we're talking here about Form 1020S, which is the U.S. income tax return for Form 1120S rather, which is actually for S corporation, must be filed in the tax year when the election is made. Okay, and so now the thing here is that when you actually think about after the conversion, you got to also think about the tax side of things. So I mean, I'm talking about the state side of things. So everything I'm telling you, 1120S, 2553, those are considerations that happen at the federal level. But you want to also think about the impact that's happening here at the state level. So depending upon your state, you probably have to do a few things here and there. And please make sure that your shareholders agree to the change. And you have to think about the fact that S corporation has a specific rules. For example, you cannot have more than 100 shareholders. In addition, all those shareholders must be U.S. citizens or U.S. nationals or people who are here. Okay, and there are some corporate requirements. There is some capitalization requirements. So those are we actually have covered this on other shows. So I'm not going to spend too much time on it here. But the bottom line here is that S corporation an S corporation status is a more restrictive status than a C corporation. So just think of you got to be a little more prepared when doing this transition. Thank you so much for your attention. I really appreciate it. In today's conversation, I'll just explain to you how to go from C corporation to S corporation and what are the tax implications. Thank you so much. And let's quickly do a recap here. So I spoke about the issues, the 5 main issues: the big tax, passive income, life of inventories, unused losses, and other issues. And also give you a few pro tips and the bonus and the approach. Thank you so much. God bless you. I'll speak to you another time. Until then, remember, stay marvelous.